They don't want to let us be great. I mean, they knew that this episode was going to be so amazing. So
Oh my God.
I don't know what
This
is
has never
happening.
happened. This
This
has
has
never
never happened before. So this is hilarious. But we going to get this presentation knocked out if it's the last thing I do. So to the folks over at Streamlabs, get your stuff together. Because if not, I don't know. Well, we don't really have to worry about this very much more because of the fact that we're getting ready to be just doing pre-recorded shows anyways. All right. So let's do it. All right. So we are back up and running and
Who's first this time?
first time it's actually D'Angelo for the
Hey,
first time
D'Angelo.
ever. Mr. D'Angelo Barr. All right. So we are back up and live. Let us know if you guys can hear us. I don't know what the technical difficulties is. But yeah, somebody said just edit the other intros into this one after it's been uploaded. Look, at this rate, let's just get into the presentation because, like I said, there's a lot to get into. So let's just go ahead and knock it out, shall we?
Yep. Oh, yep.
Yeah, let's just do it. All right. So, as you can see, market outlook. So we already know where we're at here. All right. Let's talk about understanding market projections, interest rates and market impact, market psychology and investor behavior, continuous learning and adaptation, potential bull market scenario till election, and summary and key takeaways. So, market projections, very simple. It's an overview of how market forecasts are constructed and interpreted. When we think about interest rates and market impact, examining the role of interest rates in shaping the market. When we think about the psychology or the market psychology and the investor behavior, it's pretty much insights into how investor sentiment affects the market, just in very simplistic terms. And then, of course, when we think about continuous learning, the need for ongoing education and adaptation in investment strategies. So kind of like variable change, as things change, then so too sometimes must your strategy to become adaptable. And then, of course, we'll get into that bull market thesis that involves some things that could possibly tilt. And then, of course, we'll get into some key summaries. So let's get into it. So first things first, let's look at deciphering market forecasts. So when we look at it, it's pretty much simplistic way of thinking about market forecast is, as you can see, this is the S&P year-end target for 2024 by most of your investment banks that have ultimately added their ratings for it. At the top, you see Fundstrat, and then, of course, you see Oppenheimer. And then, of course, at the very, very bottom, you see JP Morgan at 4,200, though I believe that has been adjusted since I was able to do this presentation. So there we are. But the easiest way to look at it is it's like past performance economic indicators with qualitative insights such as policy changes and global events. So when I think about performance and economic indicators, those are quantitative, right? You can quantitate performance, you can quantitate economics, as well as like some of the other things. When you think about like earnings, when you think about things that are qualitative, those are things like policy, as policy changes, and then also global events. Those are the things in which that we look at. So when we look at those market projections, that's ultimately how we do it. And this blend helps in creating forecasts that are accurate as possible given the current information that's available. So, of course, you can have, say, for example, qualitative and quantitative data that's been placed in front of you. But again, if the variables change, then, of course, you're going to have to go back to the drawing board. Hence the reason why when you normally hear about earnings reports, you typically see analysts have to go back and readjust their earnings if the data itself has changed. And AKA, the best example that I can use for that in this year was NVIDIA. So when NVIDIA was supposed to report $5 billion in, I think it was in profit, and then they reported $11 billion in profit. That changed the entire thesis on a quantitative and qualitative perspective, which forced everybody to have to go back to the drawing board and have to readjust. So every single part of your thesis that you originally had, throw it out the door and then come back with new data and then come up with a new formulation as it pertains to strategy. And that's ultimately what happens. Okay, so let's look at some of the views of some of these companies or some of these firms, right? So let's start with the firm, aka JP Morgan. So they forecast stable economic growth with attention to consumer spending and global trade impacts. Now, Goldman Sachs' perspective is that they predict, as we can see, 5,100, factoring in lower inflation, potential Fed rate cuts, and then, of course, Citi, not to be outdone, they highlight geopolitical risk and technological advancements as key influencers of market trends. So if we look at that as it pertains to Goldman Sachs 5100 price target for 2024 is based on factors including what? Inflation trends, Federal Reserve policies. So if the Federal Reserve policy says that, okay, hey, we're going to start cutting sometime next year, and we expect 3 rate cuts, that changes the entire thesis because it knocks out that entire thesis of we're going to stay here higher for longer. Well, I guess that's not it. Now, one thing to remember, and I didn't get into this part, but forecasts are tools. They're not crystal balls. Let me run that back to
again.
you. Forecasts are tools, not crystal balls. They guide us about possible future trends, but are not guaranteed outcomes. So as investors or as people that are just like studying the market, you should only use them to inform yourself, never use them to solely dictate your investment. If you do that, then essentially like there's a lot of folks out there that literally just go off of the investor's research. But another way to look at it is, let's take Morgan Stanley. And don't get me wrong, Mike Wilson is like he's very astute. In 2022, he was absolutely correct. He literally called everything as it pertains to the market going into bear market. He said that like valuations were going to be completely restructured. And essentially we were going to see inflation run rampant, and that was going to like literally it was literally going to throw like ice cold water on the market. He was absolutely correct in 2022 and really in 2021, preparing for 2022. Now, in this year, he's been completely wrong. And it happens. It happens to the best. So it just goes to show you that these are forecast tools based upon the information that they're currently utilizing, but it should never be treated as, say, for example, like the end all be all to like, okay, hey, that this is going to be the solution to everything. Which leads us into the interest rates, the market's pulse, right? Because the market's really like, and that pulse really started pulsing as soon as Chairman Powell said, look, listen, we expect 3 rate cuts in 2024. I mean, people were expecting, maybe 1 or 2 rate cuts, but then when you said 3, risk on, or so it stands for 2023. Now, of course, we understand the role of central banks, but if you don't know, the role of central banks is like pretty much like the Federal Reserve in the U.S. Set the baseline for interest rates, influencing borrowing and investment decisions. Their decisions are based on various economic factors, including inflation and employment data. So that's their dual mandate. And then, of course, it has a direct impact on, AKA, the market. So when we think about, like, to sum it up in a nutshell, lower interest rates generally make bonds less attractive and equities more appealing due to cheaper borrowing costs, right? So if that's the case, it's no wonder why you're seeing treasury yields literally like coming significantly down, because people are saying, okay, hey, this is the best of the best that we're probably going to have. And essentially what's going to happen from here is we're going to buy at these higher yields while we still can. And ultimately you just saw where I think it was the 2-year, it went from 5.4 to like now, I think it's like 4.9 or not 4.9, but like maybe like 4.3 or 4 point something. Whereas it was at a significant high. But meanwhile, you still see the 3-month at like 5.3, 5.2, 5.4, something like that. All right. So changes in interest rates can significantly affect different asset classes. And so just like I had said, when we look at the lower interest rates, right, that changes because of the fact that bonds are less, attractive. So when we look at this, anticipated rate cuts in 2024 can make borrowing cheaper and potentially boost stock market investments. So AKA, you move from one asset class to the next, which is bonds are less attractive. So that makes equities more attractive. So investors should monitor these trends as part of their strategy, understanding the broader economic implications. All right. So if we look at the role of interest rates, pretty much interest rates set by the Federal Reserve are crucial in determining the borrowing costs and overall economic health. The impacts on the investments is higher interest rates generally lead to lower stock prices due to increased borrowing costs and reduced spending. So if you notice, a lot of companies were forced to reduce their spending, AKA laying off a lot of people, which ultimately slowed things down, and which that ultimately Since the borrowing costs were so high, then essentially you didn't really see anybody taking out any significant loans. AKA, look at the mortgage arena. Nobody was really buying homes at, like, let's say 8, 9, or 8% or 8.5%. But
It's
now that
stall.
say that again.
There was definitely a stall in the market.
Yes. And then ultimately, now that we start seeing that interest rates are starting to come down in, like, certain areas, that though that they haven't been cut, but with the expectation of things that will be cut, you started seeing mortgage rates come down and other rates coming down, which is also influencing people to go out there and refi, or, say, for example, take out HELOCs, or even go out there and be buyers with the potential of, hey, I'm going to buy now with the understanding that maybe 6 to 9 months later, I'm probably, with all these rate cuts, I could probably refinance my home at a lower interest rate. So when we look at the predictions of continued higher interest rates with potential cuts impacting the market recovery, at that point it starts to become a little bit more sector specific. So different sectors react uniquely to interest rate changes. Financials may benefit from higher rates, while high debt companies might struggle. So what would be the strategy behind that? Well, this is where your investment has to become more adaptable and adapt investment strategies to anticipate and respond to interest rate changes. Consider bonds and fixed income in a rising interest rate environment, or consider equities in a lower interest rate environment. So hence the reason why you have been seeing a lot of stocks ultimately rallying. But when we get a little bit more refined in 2024, you should really look at, okay, hey, who stands to have the strongest use case? I hope you write that down, use case. Who has the strongest use case in 2024 with rates being cut in the second half, or let's say the middle of next year? What industries, what sectors stand to benefit the most? What companies stand to benefit the most with a lower borrowing cost? What companies stand to benefit more when, say, for example, the borrowing cost for their consumers isn't as high? Okay. Since we're still live and we haven't had any issues, I'm going to keep running.
Right. I said I think we're stable now.
I think we're good. I think we're out of the woods, but I'm not going to jinx it. All right, so let's look at investor sentiment, aka the market's mood. Now, here's an interesting thing that kind of and it gets the best of the best. For example, in 2022, my investment thesis was that great companies are still going to be great, even though that we start seeing inflation run high. Their earnings are still going to be pretty solid. They're still going to outperform the best of the best, and especially when it comes to the tech sector. Was I wrong on that? Absolutely not. I was not wrong. But the thing that literally caught me, sentiment. Sentiment had changed. You could have great earnings and everything else, but if the temperature or if the market's mood is significantly different, where it's like no matter what they hear, they still, like, Wall Street still wants to short, because of the fact that the other factors that they look at are still considered greater than what your original thesis is, then that could change everything. So let's look at it from the sense of behavioral finance, right? So behavioral finance simply studies how psychological factors influence financial markets. Now, if you've been paying attention to executive education, here comes the true test, because if y'all didn't know, the Matrix this year is kind of like finals week. So all of y'all are going through finals, because if you can make it past the Matrix, then you can make it into anywhere. I mean, and that's where to Toronto, because there's been people in the Matrix and they've done so much better after that. But, you know. All right. All right. So when we think about behavioral finance studies, right, and how it studies psychological factors, let's look at it from a simple thing. It examines patterns like overreaction to news, herd behavior. So when everybody's bullish, then there's like the canary in the coal mine, which that one person is bearish, or vice versa. Or say, for example, if everybody's just thinking that the sky is falling, somebody's just like, opportunity. And the impact of emotions on investment decisions. So, for example, let's look at market psychology, which is a widespread optimism about a new technology does what, right? What does it do?
Get you excited.
Exactly. So widespread optimism about a new technology can drive stock prices up, while widespread fear during a crisis can lead to markets selling off. So historical cases such as the dot-com bubble, or say, for example, the 2008 financial crisis, illustrate these patterns, right? And so let's look at some of the big three and see what What is it that I'm saying? How does it stack up to them? So when we look at JP Morgan's perspective on sentiment, they stress the importance of investor confidence in market stability and growth, noting the role of consumer spending and investment trends in shaping sentiment. Okay, so there, as you can see, I mean, it's there. Now, which leads me to that other part, which is that rational investing part. Strategies include setting long-term goals, diversifying portfolios, and avoiding impulse decisions based on short-term market movements. Now, we tend to see a lot of that where it's just like, in our world, sometimes it's looked at in retail side, it's looked at as FOMO. When I always look at it from the stance of, I always like to do a temperature check when the people around my city who don't ever talk about anything that's market based, and then next thing you know, they bring it up during dinners and stuff like that. It
Yeah.
really makes me raise an eyebrow for some reason. All right, so when we look at Goldman Sachs on investor behavior, though, they say, or they highlight how investor expectations of interest rate cuts and inflation trends can drive market optimism or caution. Well, look at where we're at today. All right, and then let's talk about Citi, because they shouldn't be left out of this conversation either. They point out the impact of geopolitical risk and technological advancements on investor sentiment, indicating a potential for both optimism and volatility at the same time. So let's bring all these views together, right? So here's what we can look at. All three banks agree on the significant influence of global economic conditions and policy decisions on investor psychology. Who would have thought? They're all eating this. Let's say that they're all eating from the same bowl.
Yeah.
So what they would probably say as it pertains to guidance for investors is based on these insights, and like it should be encouraged that, investors to balance emotional reactions with factual market analysis. And then on top of that, we're going to stress the importance of well-informed, steady approach to investing decisions. So that's really where it's going to come into play, where it's pretty much in simple terms of saying, stay even kill.
Yeah, and also look at the other side of the coin. Build the other case.
Mm-hmm. Okay. So let's talk about the long-term focus real quick. Because let's knock it out. So the overall thesis is that all three institutions advocate for a long-term investing outlook, suggesting that it is more reliable. It's a more reliable method of navigating market cycles and achieving growth, which I may get into in a second if I can.
Okay.
If it's not too late. And then the takeaway from this is that develop a long-term investment plan, focusing on sustained growth and resilience rather than reacting to short-term market movements. Now, if you're a trader, then of course you're going to react to these things, or you're going to ultimately strategize and have a trading plan that's more so geared towards the short-term swings, especially the volatile moments, or trying to anticipate them. So let's hear what the folks over at JP Morgan advise. So they say focus on steady long-term economic trends, emphasizing the importance of looking beyond short-term market fluctuations. And then Goldman says highlights resilience of the market over the long term, advising investors to look past immediate uncertainties to the broader long-term growth perspectives. And Citi's perspective on the patience on growth is they underscore the value of patience in investing, suggesting that long-term strategies can yield significant benefits despite short-term market volatilities. So
they're saying the same thing.
They are saying the same exact thing, which is pretty cool. All right, let's get into it.
Yay,
because
this.
Yeah, who says that? And who says that people can't work together, right? even if they work on different sides of the coin. All right, so let's talk about this continuous learning, because the ultimate goal of continuous learning is to stay informed. I think that's the number one thing. Stay informed. So let's talk about this real quick. So let's look at it from the standpoint of We'll start with Goldman's research, because I think that that's going to be very beneficial. So Goldman's research focuses on market dynamics, including shifts in technology, government policies, international trade, can influence investment strategies. Okay, that's fair. They advocate for investors to stay agile and responsive to these changes which can sometimes be rapid and unpredictable. Fair. JP Morgan says understand global economic trends, sector specific developments, and the impact of macroeconomic policies. They suggest that an investor who is well versed in these areas is better positioned to make knowledgeable decisions.
Okay.
And then when we have our folks over at Citi, the reason why you guys hear me reading this is for folks who are going to be listening via podcast, or if you were going to probably turn around later and listen to this, you don't have to look at the screen. So boom, there it is. All right. So Citi's view covers a broad range of factors affecting the markets, from geopolitical risks to environmental social governments, aka ESG. Their viewpoint underscores the importance of proactively learning about these aspects as they increasingly become critical drivers in investment decision making. Okay. Now, you would look at all these and you would say that they're unique, right? Like they all focus on various different things. But here's the part where the message becomes very unified across all three of these institutions. And if you probably added in more into this ingredient, it would probably even get more refined. But pretty much it says that all three institutions converge on the idea that ongoing research and a deep understanding of evolving market conditions are essential for successful investing. So, AKA, be adaptable, be like water. So, let's get into some of the other stuff, right? Because I've been talking about these three for a little bit of time now. And, you know, let's play a little game called What If?
Okay.
So, Jolene.
Yes.
As you know, 2024 is an election year, right?
Yes. Mm-hmm.
And I'll take this off of the screen because we're pretty much at the end of that slide. So let's just say, what if all three of these, investment banks got together and said, you know what? Let's all focus. Let's all get on the same page and let's all work together. And then let's just say, for example, as you can see, there's a lot happening on the political sphere. Now, remember what I said earlier this year? Of course, people vote based upon whatever their economic focuses are. So there's typically 6 focuses as it pertains to economics. My mind is kind of slightly drawing a blank given all the things that have transpired, given that this is like take 3 of our show. But, like things like Medicare and all those other things, like those are all economic factors, and people vote based upon their interests. Now, of course, there's this thing that tends to say that Wall Street tends to know, kind of like who the premier candidate is going to be, who the next president is going to be.
Mm-hmm.
Now, let's roll back the clock a little bit, shall we? Now, of course, Uncle Charles says y'all pay attention. So I hope that y'all pay attention because I'm about to cook. So for the 173 people that are sitting back and watching, I hope you take out pen and paper because, listen, if not, I escalate it to a higher power because it's above me. All right, so what if, say, for example, things got spawned around the same time that we saw that Silicon Valley Bank and many of the other banks were having those issues earlier this year. Now, remember, we also started to see that essentially that certain banks, their depository went above a certain threshold as it pertains to what was allowed. And I think the number was about 10%. Some banks hold now over 10% of the country's overall deposits, which is crazy. But, I mean, we're here now. Now, what if I was to tell you that essentially that given in the current stance of where we are, because there's a lot of companies that are limping to the finish line here in 2023, and especially since they haven't been able to borrow any capital, given in the sense that borrowing costs have been significantly constrained.
Yes.
What if by chance that they may not make it through 2024, and they probably, instead of getting a bailout, they get more so acquired? And what if those acquisitions happen to be some of those same companies that I was just talking about as it pertains to the folks that were giving their market insights as it pertains to their 2024 outlooks? So that would be interesting. So what if JP Morgan, Goldman Sachs, and Citi, were some of the premier banks that are ultimately acquiring, let's say, other banks next year? And let's just say that essentially that they probably already know who the winner of, or they make a very good guess of who's going to be the winner of the 2024 election. Mm-hmm. Based upon, of course, quantitative and qualitative numbers and data. They could see that, okay, hey, that this is probably the best option. also, given in the sense that you are now running in a specific political environment that was caused by a particular person, that essentially has opened up the doors for you to do other things as it pertains to expanding your empire, aka your firm.
So, what is your exact question? Because if
Hold on. And what if in return, given
mm-hmm.
that the government has now scratched their back, that in scratching your back, you scratch the government's back by making sure that by the time when they get to the election time,
Mm-hmm.
that essentially you're looking at a bull market run all the way up to election day.
Well,
Now,
first,
of course, given the decrease in, of course, disclaimer, of
mm-hmm.
course, given let's say a minus 2.5% to 5% drop here and there, but nothing too significant, and which could possibly lead us past let's say a 5100 to possibly a 52, 5300 price target in the S&P 500.
Let's back up. So
I know I said a lot.
yeah, so a couple of slides earlier, we saw that the majority of the banks had that 5,200. So
Correct.
let me just check in right quick.
Mm-hmm.
So if everything you just said bakes in all that 5,200, so they're essentially letting us know a couple of things. It sounds like they're signaling, one, they're banking on a certain candidate to create a certain investor environment. And if it's bullish, Lord. Okay, I don't want to say that part. But if it's bullish, then that does indicate who might be potential winner. If it's bullish, like if we look at past performance in the market, we look at which candidates are more market friendly.
Mm-hmm.
Then, Lord. I don't necessarily want that to be it's always such a conflict, Mark, because it's like you have your personal ideologies, but then you have a candidate that is good for your portfolio. So there's always that.
Remember what I said? People always vote based upon their economic interest.
Right. So if we're voting based on economic interest.
Look, there's about to be some Hunger Games. I'll die for my district.
Well, we also need to see what's going to happen with the Supreme Court, because Colorado just said.
Yeah, but I mean, let's just say that
it's going to kick to a conservative Supreme Court. So if
it's true. I mean, I think the Supreme Court is already conservative. Yeah, we understand that. But at the same token, imagine going into those debates and being able to say, well, hey, this is where the market is.
Okay, so
I'm just saying, look.
Oh, Lord. Okay.
I'm just saying, okay, let's play devil's advocate. Let's play devil's advocate. Okay, so, and mind y'all, I'm gonna keep it straight, on the money side. I'm gonna keep it straight on the money side.
Well,
for me, I don't ideology and all this other stuff. Look, that ain't got nothing to do with me.
Focus on the money.
I just focus on the money.
Okay.
So let's say let's give the other side of that coin, right?
Okay.
This is gonna be really hard.
Yeah.
But okay, let's look at it from a simple perspective.
Mm-hmm.
Let's say, for example, that they do hitch their horse to that wagon.
Okay.
But then at the same token, somebody just starts they start falling in the polls and everything else.
Mm-hmm.
They're gonna have to make a pivot. I know your phone is blowing up right now. People are like, "Wait a minute, what?" I'm just saying that essentially let's examine the subject matter here.
Mm-hmm.
When you have specific individuals on a specific party that nobody can really judge against, because let's look at okay, hey, you have a specific individual that's running that's based out of Florida, but yet at the same token they're beefing with the IPO company, a company that's publicly traded, that sits in a portfolio of a lot of those, a lot of your clients. But then you have, like I said, let's just say that if the opposite happens, right?
Okay.
You have to think about the perks in which that like ultimately it gives Wall Street. Now, when Trump ran for president in 2020, right? Or what was it?
Well, he was elected.
He was elected. He was elected. And so when he was elected, he made a lot of deals with, let's say, Wall Street to say, okay, hey, let's lax some stuff here. But keep in mind, Chairman Powell has been having to go head to head with the Treasury and Janet Yellen. And who do you think just won?
Wait, let's back up, Mark.
Because remember, the Fed was raising rates all this time, right? The Fed was raising rates all this time. And, for all we know, they can, if things change, then they can raise another rate, right? But the Fed was raising rates. But at the same token, the U.S. Treasury was still spending. It's like, all right, I'm every single punch that I land, I got two that just land back in my face.
Yeah. So
your hands are tied behind your back.
So then it gets okay. So now we have to look at.
I'm trying
it's
so hard.
It's hard to make.
I'm trying so hard not to like give away everything, because of the fact is, of course, you want people to go out there and learn it for themselves and also read and come to their own consensus or come to their own thesis. But it's a strong what if, right? Mm-hmm. It's a strong what if that if, say, for example, in order to essentially appease your voters and to appease the American economy. And then on top of that, remember what I've always told you guys since day one. It's funny how like all the things that I'm talking about today are coming back full circle in year 4. Interesting. The biggest wealth transfer in the United States is what?
The biggest wealth transfer is it real estate? Biggest wealth transfer? Okay, it's not real estate. Then it's well, are you talking about besides like inheritances and stuff?
Chat. Folks in the chat? What is the biggest wealth transfer? Oh, see, somebody's already.
Pros.
The biggest wealth transfer in the American economy is the stock market. It has always been. When you think about like the compounding interest of what the S&P 500 does, its average is 9.8% in compounding interest year over year if you did it over, let's say, a 5 to 10 year span. So then that would mean that every year you're compounding at 9.8% versus buying a home and then ultimately selling it. And then you're probably selling it at maybe, let's say, anywhere from 20 to roughly 30%.
No, see, I thought you were talking about like actual transfers. When I think of the stock market, like to me, that's more of a heist. So I don't think of it in that sense. It's like, look,
$35 trillion. That's a hell of a wealth transfer.
Well, that's what I'm saying. Like when you said transfer, that word, I literally was thinking about passing down as opposed to taking out.
Yeah, like think about it. Like, okay, like the folks at NVIDIA, I'll give y'all another secret.
Okay.
Why do you think that should I do this?
You should.
Because we're live. Okay, we're gonna do it. Since y'all rock with us for so long, then let me share a little something with y'all. Why is it that you guys think that NVIDIA stock hasn't really been tanking as much?
Why hasn't it been tanking?
Yeah, I mean, think about it. Like, if at any point in time, like here we are, we got into in a market where it was ridiculously expensive and everything else, right? Where inflation was running rampant, people needed cash, they needed to cover debts and everything else. So tell me this, why is it that NVIDIA employees didn't sell their stock? Don't worry, I'll wait.
Well, I mean, where else are they going to go? They're making money. Like NVIDIA.
I mean, let's think about it. Like, you got a person, like, let's say you work at NVIDIA and you're getting, let's say, 14 or let's say $20 per share versus the stock trading at $400 a share. But you're getting this as it pertains to your consistent investing. Yeah. So as soon as it's vested to your account, it goes from $20 to now, let's say, almost $500 a share.
Yeah, you're holding on. Nvidia's
Exactly.
been cooking all year. They really have.
Look, I mean, the same thing happened with folks at Amazon. The
Mm-hmm.
only time when people sell their stock at Amazon is when they look to buy homes.
Mm-hmm.
So, you know, let's keep it
All right,
within
Trump says
perspective here.
we need to get a corporate gig. What you saying?
Nah. I'm gonna stick to startups because that to me is like that's where my focus as it pertains to wealth transfer is. But you know, that's where it's like, when you think about like what's happening in front of you, right? If you listen to all the data in which that we have been talking about over this period of time, you know, and we have folks that are saying prop to stay on top, fake money pump. I don't know if that's a fake money pump when essentially like they have the revenue, they have the growth, and ultimately, currently I think their current PE ratio is in mid 20s or low 20s. So it doesn't set the stock as completely overvalued. I mean, and then on top of that, you expect even further growth as it pertains to more spending from the enterprise side, given in the sense that they can now go out there and spend. They're more like companies are going to be more willing to spend starting next year, given in the sense that one, inflation's coming down with the expectation that borrowing costs aren't going to be as high anymore. So, AKA cost of capital
Mm-hmm.
is going to start coming down. Then it's actually going to make a lot of those companies, based upon their current valuations, over a period of time, it'll start to make their valuations look cheaper.
Now, question:
Mm-hmm.
have there been any whispers of any potential world events that may kick this party, close this party down early? I guess I should say.
I mean, yeah, the number one thing that could possibly shut the party down is if we see inflation kick back up. And I think that's the reason why you haven't seen the Fed, like people were expecting the Federal Reserve to do a rate cut at the end of this year, and that was not going to happen.
Mm-hmm.
So the one thing that can get the party stalled
Mm-hmm.
or or the show gets canceled is if we see inflation tick back up. Now, like I said, the conversation has to significantly change. You know,
So we need to keep our eye out on that.
so like the thing is, and again, that's just a what if. Now, notice what I just did there. Like based upon this conversation, did you notice some of the things that I just did? You
No.
know, remember that thing, market behavior, market psychology?
Mm-hmm.
And remember, based upon a simple thesis, as what is it what I just said?
Yep. You
Look,
basically looked at all the different, you took into that account, that first slide,
yep,
all the market psychology, sentiment, all that. And then you did the bear case, or you did the bull case,
uh
and you
huh.
did the bear case.
But did you notice how it also started to impact your psychology as it pertains to what you thought about the market?
Yeah. As we're talking about it right then and there. Yeah.
Like, for example, if we like literally did, if you're happy and you know it, clap your hands, like something like that. But I mean, so when we think about it from that particular perspective, right?
Mhm.
Like the biggest things that I can probably, of course, give folks is, you know, remember these are theses that ultimately, some way, somehow, they're gonna have to play out, and also sentiment will also have to align, or it may not align. Another thing is, continue to stay connected. Stay connected to reliable information, reliable sources of information. Um, so those types of things. The other thing is like also challenge, your existing thesis of what you have. Like, for example, if I'm completely wrong, then essentially that the market becomes very volatile throughout the year until we actually see that first rate cut. And I think that honestly, that first rate cut could possibly signal a sell off, because now it's like, okay, hey, that's news to us. And given in the sense that the market now knows that, it's like, okay, hey, it gives people a breather where it's just like, okay, hey, I don't have to be in this right now. But it depends upon, say, for example, how fast or how aggressive things are, that it may actually force investors. Like, have you ever noticed like how aggressive things are? Like, for example, people realize, okay, hey, I want to get out of the stock, but it's still going up higher. and at the aggressive rate of how fast it's going, then essentially it can kind of like change your it challenges your entire thesis at that point to say, okay, hey, should I still be a holder? Well, hold up though. Like it hit 200, it could possibly hit 225. It hits 225 that fast, and then 225, you're like, oh, I mean, can you squeeze 230? or and then it blows past 230, and then it is like, all right, we going to 260, and then next thing you know, it stops at 250. It's just those types of things where it's like the market is going to probably put people in that type of mindset where it will ultimately challenge. It will definitely challenge, like, let's say, a lot of folks thinking of where is it that they see, the market. Now, of course, it's like, folks who take profit, like, you don't lose money taking profit. It just depends upon wherever your thesis is. Like, you're going to probably even see some money managers take profit from other places because of the fact that essentially their clients want profit or whatever it may be. You never know. Like, there's so many different variations as it pertains to why things are happening.
You can at least shave off your initial, principle.
Yeah. So, those are the things in which I look at as it pertains to, when I think about the outlook, all the data that we shared with you today, those are the things that sit up on my mind. And it's kind of interesting because the only thing that I took away as it pertains to like the other three major banks was I actually just looked at like, okay, hey, well, what is it that they say about this versus in comparison to my own thesis? So in an environment like that, let's say it could go one of two ways. We could be very, very choppy or trade sideways next year. And then essentially, depending on how election goes, then essentially you see either a pop in the market if Wall Street got it right, or if Wall Street got it like, okay, we didn't really get it right, then essentially you probably see a sell-off. It's really going to be in the sense of advantage. And like I said, remember what I said earlier in today's conversation? I said use case.
Mm-hmm.
Use case is more than just a specific viable way as it pertains to what we look at as business models. It goes well beyond business models. It also looks at other things such as like use cases as it pertains to who benefits more in a lower interest rate environment. That's a use case. Who benefits, say, for example, if certain individuals or certain parties are there politically and that they've done deals with Wall Street. That's a use case. Consumers. What is the state of the consumer? If the state of the consumer is weakened, then what does that look like for retail stocks and everything else? That's a use case. When we look at innovation, then, innovation is probably the easiest because we can easily see the cause and effect of things. But again, it's like, okay, hey, if we see like, all right, well, layoffs. And I think somebody says, hypothetically, won't there be, Mr. Buchanan said, hypothetically, won't there be more unfortunate layoffs before the big turnaround? I mean, I'm not saying that essentially that we won't see more layoffs. I mean, it's not to say that. And, it's kind of interesting because, when you see more layoffs and if you see unemployment goes up, then that plays into the Federal Reserve's thesis anyways. So that gets closer towards like the slowing down in the economy, which gets the inflation rate to 2%. That's the target for the Federal Reserve. When we see when we get to that place, when the data starts going in the direction in which that everybody expects it to go, then that's a good thing.
All right. Well, Mark, literally.
Yeah.
Track of those three, the big three that you mentioned,
mm-hmm.
And staying connected to that and letting that, not letting it inform, but like checking our own thesis against what they're saying.
Well, the biggest thing is not only just in the sense of like the old adage says, don't just listen to what they say, watch what they do.
Right.
So, for example, a good example is Jamie Dimon has spoken outwardly against cryptocurrency, but also his firm has also been buying crypto.
So, yeah, you need to
So, the biggest thing is just that you got to just look at it from the standpoint of what is it that people are doing, what's happening on that perspective. because therein it's like, okay, hey, that's going to tell you, like, the actions really tell you the story. What's being said, it ultimately creates the narrative, and then ultimately it's on the actions to ultimately still validate the narrative.
Okay. And I also like how you broaden out like what the use case, what a strong use case would look like beyond
Mm-hmm.
just, you know,
I do,
this.
I do want to do one more thing.
Okay.
I do want
Okay. One more thing.
to. Now, I've been very quiet. Now, of course, this isn't a knock towards anybody or anything like that. So let's keep it simple. But a friend of mine had an opportunity to do an analysis
Mm-hmm.
of, pretty much. Um, they did an analysis based upon like my thesis of things, and also what is it that I typically look at as it pertains to, let's say investment, right?
Okay.
And so here's what we got. For the folks that are paying attention, check this out. Okay, let's see if I can pull it up for you guys. And I think my dog is like, "Hold up, bro. You're past your time." Okay, so let's share this real quick. And this is just like my so
I
pull
want
it
to see
down.
growling.
He thinks he hears a door. There's nobody here. All right, so let's look at this. So he did an analysis of the differentiation between, what is it that what my thesis is versus, say, for example, two stocks, two ETFs portfolio. Okay,
Mm-hmm.
so within my port, I would look at it from a standpoint of, let's just do an analysis. So in the two stock, two ETFs, then it's pretty much Microsoft, Apple, VOO, and VTI. I
Okay.
could be wrong, but okay, there it is. And in mine, I believe in equally weighted of, as you guys can see, if I'm a permable, then this is what it would typically look like. So you have your T triple Q, SMH, Microsoft, XOK, Nvidia, Meta, VUG of growth, and of course we got our friend Tesla there. Now, one would say, "Wow, Mark, for real, that's a lot of stuff there." Now, of course, it can get very, very interesting. But if we look at, say, for example, the risk over reward as it pertains to, let's say, the two stock, two ETF, in 1 year, that produces 26 and a half, which is not bad. But then at the same token, this produces 76%. And then as you can see over the years, it ultimately beats that ultimate benchmark. And the benchmark is ultimately the S&P 500.
Mm-hmm.
And this is kind of like one of my overall thesis as it pertains to essentially what is it that we look at. And then of course, if you look at it over the course period of time, over a strategy, and let's say if we just take it all the way from 2020 or 2019, the purple represents, aka yours truly. And of course, he's definitely beating the benchmark. But then at the same token, it's like, there we are as it pertains to performance. Now, of course, there are some drawbacks on what is it that my portfolio would potentially do, which is also the drawdowns, and that's the part where it can definitely go in because you can go to a drawdown of about 52%. But at the same
So
token, that
more
it's a
risk.
52%. But
Mm-hmm.
that's again, this is just holding the stock if we're just talking about just keeping it simple.
Mm-hmm.
So my drawdown is definitely a lot higher, but at the same token, the overall return, if you look at it across the board, no matter what, it beats it.
Yeah, those numbers are even the visual
Yep.
goes hard. Okay.
And yeah, so somebody said, and this isn't using leaps. No, this isn't using leaps. This is just, say, for example, if you're just looking at the stock. Also, mine doesn't have any management fees, also. So there's that too.
Okay. Wow.
Yeah. So, I mean, it just goes to show you that there's many different variations as it pertains to getting to whatever your thesis is or whatever your objectives are.
Mm-hmm.
honestly, this doesn't make me the greatest investor of our generation or anything like that, or none of that. It just goes to show you that it just gives you an alternative as it pertains to what to see and what's available, or how is it that you construct a portfolio. Somebody was asking what website is that? That was actually done via Y chart. Shout out to Chris Bush, who ultimately did the compilations and pretty much ran the due diligence behind it. So of course now Chris, he can easily concoct an easier portfolio that can literally kill mine, but but when he looked at it and he tried to break it apart, and he looked at it over, if you were to hold it over a 5-year period, then that's about a 480 something percent return over this period. Now, of course, that's taking into consideration the pandemic. But even then, when you saw the charts, even before the pandemic, well, yours truly was still sipping water.
Oh, good old Chris.
Yes. And on that note, thank you guys so much for watching. I hope that was enough to essentially, kind of like entice you to also continue to keep your research up and going, and also to even examine it against your own thesis. But yeah, that's pretty much all I got. Until next time, I'm Mark Monroe.
And I'm Jalen GC, in the place to be.
And this has been Executive Education. We will see you for our finale next week, the day after Christmas. So we come bearing gifts.
That'll be a good one. Peace,
y'all. Have a great night.